I want to take you through just-in-time teaching exercise number 2, measuring nominal and real GDP. So I've made it into an Excel spreadsheet, which you see here, and I want to go through that with you. So you see it completely filled out in this example. So I'm going to go through it sort of column by column. You see some markings on here already. I'll explain those. But I want to start with year number 1. We should be, right, so year number 1 here. Year number 1, that information in this column right here is all in section 2.1 of the book, all right? So I really encourage you to go back through section 2.1. It's making a point here partly to say that you need to not just read a chapter, but you really need to dig into it, and you need to understand what's in each one of the sections. We're going to be going through a lot of material that's really requires you to dig in throughout the semester as we develop our model. We haven't started developing the model yet. We will in chapter 3. But this information in the first column here is all in section 2.1. There's no changes, nothing in it that's different. The only thing down at the bottom in terms of the GDP price index, that information is in section 2.4. When we think about measuring GDP over multiple years in nominal and real GDP, that information is in section 2.4. So I've expanded the example that's in section 2.1 in your textbook to make multiple years so that we can, and with prices that are different in each year for the oranges and orange juice, the final products in goods and services, so that you can get an understanding of real GDP, also the price index, and how we measure inflation in the economy. So this first column is looking at, and what we have here marked over here is related to the expenditure approach to GDP. It's oftentimes the easiest place to start. What's important, and it's very simple, but it's very important, is that it starts with the definition of GDP. In this case, nominal GDP. So the definition of nominal GDP is the value of all final goods and services produced in the economy in a given period of time, typically a year. So this economy has two producers, Orange Inc., Juice Inc., and Orange Inc. is producing oranges, or some of the oranges are sold to the public. Some of them are sold to Juice Inc. as inputs into the production of juice. So for Juice Inc., those 50,000 pounds of oranges are intermediate goods. They're not included as part of GDP. But oranges sold to the public in their final use, final goods and services, are. So this 10,000 indeed is part of nominal GDP in year 1. For Juice Inc., what they're selling is juice. And the final product for them is orange juice. And so they sell $40,000 worth of orange juice to the public, 40,000 and 10,000, that's 50,000. And then, so we know the answer actually, as we've read the chapter, that all different ways of measuring GDP have to be the same. So we know it's got to add up to 50,000. If we add up the income, right, in section 2.2, it goes through the actual U.S. economy and showing different kinds of income that get generated through the production of goods and services. All right, firms hire employees, they pay taxes to the government. What's not here, there might be shareholders, right, that get paid as well, dividends, stockholders, etc. That's all income. And we can figure out the profit, right? It's total revenue minus total cost. Again, for year 1, that information and how to do that is laid out in section 2.1. So we can measure the profits, the wages, and the taxes for both companies. And if we add that all together, it's going to add up to 50,000. right? If we add up the value of final goods and services produced, the value added by each firm, if you go back and look at that in section 2.1, you'll note that that also adds up to $50,000. So before we come down to the bottom here, let's take year 2. So why are the numbers in year 2 for nominal GDP potentially different? Notice that we're using the same quantities, right, in this example in year 1 and year 2. All right, so the quantities aren't changing. That's going to be critical when we get over to real GDP. But what is changing is that there's the prices. So the prices are changing in year 2. Prices of oranges go from 50 cents to 75 cents. Price of oranges per gallon, orange juice per gallon goes from 80 cents to $1 a gallon. So if there are oranges being sold to the public, 20,000 pounds, now 75 cents per pound, that's going to be 15,000. And oranges sold to Juice Inc., right? Those oranges are 75 cents. 3/4 of 50,000 is 37,500. Going to be the same number down here. We're assuming that wages and taxes, as we said here, are staying the same in each year, both in terms of real and nominal. So those numbers aren't changing. The revenue received from 50,000 gallons of juice, right, used to be 40,000 at 80 cents a gallon, but now it's $1 a gallon in year 2, and so it's 50,000. So again, the 50,000, right, of oranges sold to the public and $50,000 worth of juice sold to the public, that's $65,000 worth of final goods and services that have been both produced and sold to for their final use. In this case, sold to the public. Again, we can add up wages and we can add up profits. What's going to be the wages and taxes are going to be the same here as they were in year 1. What's going to be different is the profits, right? Partly because the price of oranges and price of orange juice is increased while the cost of the labor and the taxes paid haven't. So profits are going to be higher in year 2. And so those are all going to add up to 65,000. So nominal GDP has gone from 50,000 to 65,000 from year 1 to year 2. And in this case, we'll come back to real GDP down here. We need that in terms to get the price index and to measure inflation. So as it turns out, with real GDP, right, these green columns over here, right, one of the things that, right, we know in terms of the definition of real GDP. So we start with the definition of nominal GDP. We start with the definition of real GDP. Real GDP is the value of all final goods and services, not intermediate goods, final goods and services produced in the economy in a year, but this time measured in base year prices. So we have to indicate which year is the base year, and we're assuming the base year is year 1, right? We talk about that down here in the blue. Okay, so we measure the value of output, right? So 20,000 pounds of oranges, 50,000 gallons of orange juice, and we're going to measure that each year in terms of base year prices, in terms of year 1 prices. But that's the same thing as nominal GDP. Nominal GDP, the definition of nominal GDP is the value of all final goods and services produced in the economy, right, in a year, in the current year prices. But year 1, when year 1 is the current year, that's also the base year, so the numbers have to be the same. So nominal GDP and real GDP in the base year have to be the same. So the numbers are all the same, right, as they are for year 1 of nominal GDP. Like, we didn't even need to do any calculations to figure that out. We could have done it, right? We could have said 20,000 pounds of oranges at 50 cents a pound, 10,000, 50,000 pounds, etc. And we could have filled in those numbers in the same way that we did for nominal GDP. But if we understand the definition of what real GDP is, and we think about that for a minute, we can just fill all those numbers in. We don't even have to calculate them. We know that real and nominal GDP in the base year are the same. What about year 2? Well, we're going to measure the value of all final goods and services produced in the economy, right, in the base year prices. But what hasn't changed is the oranges sold to the public are the same in year 2 and year 1. The oranges purchased from Orange Inc. and sold by Orange Inc. and purchased by Orange Inc. to make the juice, they're the same. 50,000 gallons of orange juice was bought by the public and also produced, and that hasn't changed. So it's the same output being produced, right? Oranges and orange juice. And so if it's the same output measured in base year prices, right, the year 1 prices, it's going to be exactly the same as it was in year 1 in this example. Now, if the quantities had changed, then real GDP is going to change. In fact, that's the reason for doing real GDP. Right? We'll come back to that in just a moment. So, in this example, because the quantities aren't changing, the values of real GDP in year 2 aren't different than year 1. And so those numbers are all the same as they are in year 1 for this example. That's not always true, but in this example, that's true. Right? And so you'll see these two columns are exactly the same. Well, real GDP is the same in both years. It's 50,000 in both years. Okay? Well, that's because production hasn't changed, and that's exactly what real GDP is trying to measure. One of the questions at the end is, why do we use real GDP rather than nominal GDP? And you can see that if we use nominal GDP increased by 15,000, right? 30% from year 1 to year 2. So you might say, well, that's great. The economy is better off. People are better off. The standard of living is higher. But in reality, there's no more juice produced in year 2 than in year 1. There are no more oranges produced and sold in year 2 than in year 1. So people don't have any more orange juice or any more oranges than they did in year 1. They're not any better off. They're not worse off. They're the same. And that's what real GDP is getting at. Real GDP allows us to look at what's happening to production of goods and services, the amount of goods and services available to people, after holding prices constant. In other words, we don't allow for inflation. Well, so why do we have to play that game? Right? Because we can't just add up goods and services in the economy and compare them from year to year. Right? We measure oranges. It could be by bushels, it could be by a number of oranges, it could be by pounds, it could be by kilos, and those are all going to be different numbers. Same way with orange juice. Is it gallons? Is it liters? Is it barrels? Is it milliliters? Is it ounces? Those are all going to be different numbers. So we can't just add them up. So what we do is we measure the value of those things. Right? In the US, we measure that in terms of dollar values. And then we can just add up all those dollar values. The problem is the dollar values can go up simply because of inflation, as in this example. And so that inflates the value of what the economy is actually producing. So we want to measure where that's not the case. That can give us a real measure of the standard of living, of what's available to people, right? Even when prices are changing. And so real GDP does that. It measures the value of goods and services in constant prices, or base year prices in this case, right? And allows us to compare year to year. What's the real value of GDP from year to year? When we get down to the summary of activity down here, all right, we can just use the numbers from each one of the years, right? Nominal GDP, 50,000 year 1, 65,000 year 2. Real GDP in 50,000 in year 1, year 2. So we see real GDP, the real standard of living, hasn't changed because there are no more oranges, no more orange juice than there was in year 1. So how do we measure inflation. Right? So we saw that the price of oranges changed, and then the price of orange juice changed, and they changed by different amounts. The price of oranges went up by 50%, from 50 cents a pound to 75 cents a pound, whereas the price of oranges went up by 25%, from 80 cents a gallon to $1 a gallon. Okay, so how do we measure overall inflation in the economy? One way to do that is by using the GDP price index. And that is just simply nominal over real GDP, right, in any given year times 100. So 50,000 or 50,000 in year one times 100 equals 100. So the price index, the GDP price index, any price index, is always going to be 100 in the base year. Okay? We can prove that, okay, but that's always going to be the case. For year two, we see that nominal GDP is 65,000, real GDP is 50,000, and you divide those two to 1.3, and then times 100, it's 130. Okay, so how do we measure inflation? Inflation is the percent change in a price index from one year to the next. In this case, the price index is the GDP price index. We're going to learn about other price index, the consumer price index, and the personal consumption expenditure price index, which the Federal Reserve prefers to use to measure inflation in the course. But here we're measuring GDP price index in section 2.4 in your textbook. So how do we measure percent change? The latest minus the previous, 130 minus 30, that's 30, right? Divided by the previous, that's 100, 30 over 100, and then times 100 is 30, okay? So overall in the economy, the inflation rate was 30% based on the GDP price index. Even though, right, the price of oranges went up by 50%, the price of orange juice went up by 25%, overall, the average price and the average inflation rate in the economy was 30%. Okay, so it's important for you to go back through this chapter, section 2.1, understand what do we mean by nominal and real GDP conceptually. What's included in that? Why is it that measuring things by expenditures or income or production, right, are all the same? Part of the reason for that is when we're later in the or even in chapter 3, in the next chapter, when we talk about real GDP increasing over time, we can talk about, well, there's more stuff available to purchase. It also means more stuff's being produced, but it also means more income in the economy, which could mean more wages, more profits, and so all of those things, if real GDP is going up, it means all of those things are increasing. We're going to use real GDP as one measure of the standard of living in the economy. So it's important to understand what it is that we're measuring with that. Again, it goes back to the definition, right, of nominal and real GDP. It's a very simple definition, but it's actually really, really important in the course. If you go back to that section 2.1, you'll see where all these numbers come from and why it is that GDP can be measured in these three different ways. I wanted to spend some time going through this JiTT with you because people may have some questions, and also because it's an important concept that you understand. It also points out the importance of, as you're reading each chapter, I really need you to really focus on what's happening, probably taking notes as you go through the chapter, reading and listening to the chapter overview that I provide for each chapter in the learning unit. All right, I give you a guided tour through each chapter, but then to be able to dig into that chapter and to really understand each one of the sections, right? Because if you just kind of read over it, like you're reading a novel, you're not going to be able to apply it. And when we go to JiTT exercises or homework exercises or most important, on an exam. But if you do that, those things will become common practice, and they won't be hard to do. So again, I just wanted to provide you with some background about this JiTT exercise, and it's a fairly simple exercise, but it points out some really important concepts that we're going to be talking about.